guys, Dave the Mortgage Guy here. First off, I'm not driving right now. I'm sitting in a parking lot, but I realized I'm a little late on last week's blog breakdown video. We had a crazy week with the holidays, woke up to one of our dogs really sick, had to rush her to the vet. She's doing good now, but it was just a busy, stressful week. So got behind on some things, but I'm out running errands right now and I've got 30 minutes free. So I figured we'd dive into this. Last week's blog was about why waiting for interest rates to come down before you start shopping for a home or before you actually kind of put an offer in on something may not be the best idea. So we're just going to kind of dive in, dissect that blog a little bit. I'll give you some of my opinions and thoughts, and you guys can really just use that for your, food for thought for yourselves as you go out on this journey. So we'll dive into it here. Hope you guys enjoyed. Let me know if you have any questions. And finally, if you do find any of this helpful, please don't hesitate to like, subscribe, follow, share with other people, etc. It really does help grow the channel and the social networks that we're trying to build here. My whole business, this channel is really about helping empower people get into homes, especially people who feel like there's not a way for them to do that. I think that's a lie, and I'm all about combating that myth. We're facing some significant challenges as a country here, as a society, and I think we got to attack it from the ground up. So please, don't hesitate to share it. I can't do this without you guys, and I appreciate all of you. So thank you very much, and let's dive into it. So the real problem with housing affordability today is really an issue of housing availability. There's not really houses on the market, so that drives the price up because there's more demand. More people want to buy a house. There's not as many houses to choose from, so sellers can sell the house for more. And that's been going on for years and years. It's been driving prices up and up and up. And the part of the reason that this is happening is that developers, well, really the country, America's just not building houses the way that we used to. We don't build starter homes anymore. That's really not a thing where you could afford a single family home for you and your kids on a single middle class salary, put your kids through college, go on vacation, save for retirement. That just doesn't happen anymore. And there's a couple of reasons for that. One of it is disgusting wage stagnation throughout the entire country. But the other one is that developers, they make more money building a slightly bigger house that they can sell for closer to the median property value in the area. And the median property value in the US right now is $420,000. Now, I'll do some comparison here just to kind of, again, just give you some food for thought on this. So in 1988, that's the year I was born, we built 1 million homes in this country. And the median annual salary in the US was $27,000 a year. And the median home price in the US was $112,000. I mean, that's not bad. So really inside of 5 years, if you didn't spend your money on anything else, you could take your annual salary and pay off your home. And we built 1 million homes. In 2023, the median home price in the country was $420,000. The median annual salary, this is disgusting to me, was $37,000. So it's gone up $10,000 since 1988 in 35 years. And last year we built I think 930,000 homes. So we built fewer homes. Oh, and by the way, we had 230 million people living in the country in 88, and we have 240 million people living in the country last year. So we've got more people, we built fewer houses, we're paying people barely more than what they were getting paid 35 years ago. But the price of housing has gone up basically 4 times in that period. So now if you're making that median annual salary of $37,000 a year, it's going to take you well over 10 years, if you don't spend your money on anything else, to pay off that home. So that's the core issue here. The rates are just kind of, sprinkled on top. That's just the cherry on top. And for some reason, rates tend to get a little bit more fixation as being this kind of make or break issue, that if the rates go down, we can all of a sudden afford this house. It's just not the case anymore. You really can't go and buy a house in like a neighborhood that you've been eyeing, a part of town that you've been eyeing, and actually have a lot of breathing room left in your finances. So you got to get scrappy. Unfortunately, this is just the reality of the situation that we live in today. But that's, again, just kind of part of the picture here. There's a little bit more that goes into this, but I wanted to just kind of paint a picture of where we're at in this country right now, and kind of how rates play into it, but also how housing prices pay into it, and why housing prices are not going to come down in the near future. There's just no clear path to how we get from where we are to a place where housing prices are a little bit more reasonable in relation to what people are actually earning. I believe that in order to solve this problem, we need to get more houses on the market. We need to figure out a way to bring that median house price down, but also kind of core to all this, we got to figure out a way for people to earn a living wage. You can go to college today, you can do great in college. Maybe you come from a family that doesn't have money and you got to take out loans, and you can get a great degree in a good industry, and then you either, maybe you don't find a job, or you do find a job and they're paying you garbage. They're paying you what they would have paid you for that same job 20 years ago. And now you're expected to go out and buy a house and start a family and save for it's just nonsense, So I think, we got to talk about other stuff. I know this is kind of focused really on housing, so we'll keep it to that. But I do want to share my thoughts on that. I think it's really, really important that we see this stuff, call it out, and then don't stop talking about it. People need to vote on this crap. Not on personalities or celebrity or any of that crap. These are the core issues that everyone in leadership is ignoring. So we got to do our part to talk about it. But that's just kind of getting started for today's topic. We'll dive into a little bit more here in a second. Okay, so before we continue here, I just want to call out, if you live in Phoenix and you haven't been to Hello Vietnam Pho and Roll, there's one on Tatum across from the old PV Mall. I think there's one on Shea. The place is killer. They got this salt and pepper fried calamari, and then I got today this caramelized pork sandwich that is absolutely amazing. So check it out. But anyway, on back to the blog. So the next thing I want to talk about is housing appreciation. So housing prices rise because of supply and demand issues, but also just on average, really throughout all of history, at least in the US here, housing prices appreciate around 5% per year. So if you're wanting to buy, let's say, a $300,000 home, and you hold off for a year, that home may be worth $315,000 next year. Now, if you're only able to come to the table with the same down payment amount or percentage, the amount of money that you're borrowing will increase from this year to next. So even if interest rates go down by 1%, you're still potentially not saving any money because you're borrowing more money. So you're paying a little bit less interest, but you're paying that interest on more money that's being borrowed. So you really may not be saving money in the long run. That's why, and you're not even guaranteed that rates are gonna go down. They could go up. So you might be out, even more than that, or completely lock yourself out of the housing market altogether. All right, so my next point about why waiting for rates to go down may not be the best approach has to do with something that I harp on quite regularly, which is buying is always better than renting, even if rates are sky high. The reason is when you're paying rent, you're not throwing money away because you're getting shelter, you have a place to live, but you're giving money to your landlord. You're paying your landlord's mortgage so they can pay their principal balance down, they can build equity. As those housing prices rise, whether it's due to supply and demand or just the annual increase, that 5% we just talked about, that landlord is benefiting from all that and that equity they have in the property. You are not. You're paying them rent. You never get a return on that. So in my mind, I'll always argue, if it's possible for you to pay for a mortgage as opposed to rent, why wouldn't you do that? Even if you're paying a little bit more, if you can afford it, you still get the shelter and security, but you're also building equity for your future. You're paying, you're investing that money in yourself and your home. And also the predictability difference is huge. I mean, if you're on a yearly lease, you're basically at the mercy of your landlord to ensure that you're not hit with an astronomical rental price increase at the next year, that they don't decide to sell the property next year and you have to move. Like, the unpredictability value of that, in my opinion, is just not really worth the cost. Again, if you can afford to actually live in your own home. So again, I harp on it a lot. I know a lot of you, if you are renting, you already feel that the way that I feel about that, but I just want to mention it because I think it is super important. All right, so the next piece here I want to talk about why waiting for rates might not be the best idea has to do with competition. So if rates go down, everyone who's been waiting for the rates to drop is all of a sudden going to be entering the housing market and trying to buy a home. What's going to happen when that occurs is that the housing prices of everyone who is either already selling their home or wants to are going to go through the roof, because again, it's a supply and demand issue. You'll have all these buyers entering the market, you'll have some sellers wanting to sell, and you'll have people competing on those buy offers. So again, you're waiting for the rate to come down. Not only are you having to deal with that, that annual property increase that we talked about, that average of 5%, but when you get flooded with buyers entering the market, the price of houses that are listed are just going to increase, because those sellers are going to be able to charge more. They're going to have more competitors buying, and it's going to be even harder for you to secure the home you want, and you're going to probably end up paying more than if you just went shopping right now. So again, just something to consider. There is a flip side to that coin, which is there's a lot of people right now who probably have some pretty good interest rates on their mortgages. They've been in their home for a while. They would love to move, but selling their house, pulling the equity out, going and buying another place just doesn't quite make sense for them because of where interest rates are. So the kind of devil's advocate argument on this one is that when those rates drop, you will also see an increase in supply on the market. More people will want to sell. But from all the people that I talk to, the things that I read, the videos I watch, it seems like, my opinion, there's a lot more pent-up demand than there is pent-up supply. So I have a feeling that if let's say rates drop to 4% tomorrow, I have a feeling we would still see housing prices increase, probably pretty significantly. Just my opinion, but worth considering. All right, so second to last point on this concept of not waiting for rates to drop to purchase. Rates fluctuate over time. They're fluid, they move up and down with the market, with whoever's in power, who's at the Fed, all that kind of stuff. So there will be an opportunity to refi in the future. There's some exceptions to that, like this house, I have like a 2.375 rate. There's a good chance it'll never really make sense for me to refi on this property unless I'm just doing it to pull some equity out and don't mind taking a higher rate. But we may never get back down to those low twos. So I've seen some even in the ones. That might not happen ever again. If it does, it could be decades. But without, if we set those aside, rates fluctuate up and down, up and down. So we will not stay where we're at forever. We'll drop, we'll probably go up again at some point. So again, it's not a permanent thing. Buying the house at the price it's being sold for in today's market, that's a little bit more concrete and static. We know you can go back as far as you want. Housing prices, they only go up over a considerable period of time, whereas rates fluctuate. So if you wait for the rates to get where you want, you may have just priced yourself out of the house, out of the neighborhood that you want to live in. So again, it all comes down to what's possible if you can afford it. But if you can get into a house now, work with the rates as they move. And then the last thing I'll say here on this is that you do have the opportunity to buy rates down now. And there's different ways to do that. I typically don't recommend it for people, but if rate really is a concern for you, you can actually spend some money and get a lower rate. So if you're holding off because of the rates, but you actually have some equity stashed and you have enough to cover a down payment and then some, there's ways to get your rate lowered regardless of where the market's at. So just keep that in mind. All right, last thing I want to touch on, I know I harp on this, but if you are going to wait to buy, whether it's for rates or to save for a down payment or anything like that, please, please, please keep your DTI in mind. If you're not buying right now, take a look at your DTI, which is your debt to income ratio, and make sure it's below 50%. So what that means is your monthly obligations, credit cards, personal loans, car payments, all that kind of stuff that you're obligated on. You want to total all that up, and it's going to include your housing. So right now, if you're renting, it would include your rent, but when you move out of the place you're in and buy, your mortgage payment, your principal, your interest, your HOA, that's going to replace your rent payment. So your DTI is all of the expenses that you have, your obligations, compared to your monthly income pre-tax. And in order to qualify for most mortgages, that number needs to be below 50%. So what that means, if you bring home pre-tax $8,000 a month, all of your total obligations cannot be more than $4,000 a month. So keep an eye on your DTI, and if you have some runway between now and when you're going to be able to buy, and your DTI is a little high right now, maybe you've got some credit cards or a car loan, focus on paying those down, because it's going to make it a lot harder, if not impossible, for you to get a mortgage if you have a high debt to income ratio. So just something to kind of keep in the back of your mind as you're thinking about this process. And that's pretty much it. That's all I got for you guys today. Again, I really appreciate you. If you watched this whole time, please subscribe, please like and share. It really goes a long way. But look forward to connecting with you guys again next week. Take care.